On the other hand, you have a Dixon Tech. Profit has more than doubled. Revenue has jumped 117%. Margins were flat, but you have the stock down nearly 10%. We're going to be speaking to the CFO shortly, but before that, let me go across to Mihika. Mihika, why is Dixon hurting this morning? What is the street seeing?
Yeah. So up first we have, brokerages that have trimmed the FY25 estimates. We have MOSL that has lowered its FY25 earnings estimates by 8%, Novama to the same degree. And, all the growth that we've been seeing is from the mobile segment, which is a significant revenue contributor, but their consumer electronic division has been facing weakness in terms of demand due to seasonality. We've seen revenues and operating profit contribution from the consumer electronic segment, which includes your LED TVs and refrigerators, dropped to 6% versus 17 to 19% a year ago. And this is a segment that is the second highest contributor to Dixon's revenues, and it's overall seen a 32% degrowth this quarter. And the street is also cautious on valuations. The stock is up 2.7 times in the past 1 year. Their current PE is at 262 times as per Bloomberg versus the 5-year average that averaged around 97 times. We've also seen an increase in debt. It's at 361 crores total debt in Q3 FY25 versus 155 crores at the end of FY24. The company's also announced a new JV in terms of a fabrication display setup. Now, while it does, it's a wait and watch from the PLI subsidies for the government, there is, the street may not be taking this very positively because it could hold up a lot of their working capital in. And lastly, while their mobile segment has been seeing strong growth, it's seen higher revenue contribution. The street has been saying that they could have an impact on margins because of rising competition from the Tata Group.
Factors there, Mihika. Thank you for that setup. Saurabh Gupta joining us now, Chief Financial Officer at Dixon Technologies. Saurabh, very good morning to you. And, we were just trying to figure out what the street is seeing in your numbers, because in the face of it, it's been a fantastic quarter. A beat on estimates on most earning drivers. Margins, yes, is flat. So let's start with the fabrication foray and the $3 billion that it will cost. How will you fund it? Let me start right there.
Yeah, good morning. I think so. Display fab is in line with the strategy for backward integration. You know that we have a big play in LED TVs, in mobile phones, and now going forward in IT hardware products. So the display fab will be basically used across all these three categories, and we have a large volumes. So it is basically, we plan to get into that, so create more strength and moat around these businesses. Yeah, so the total capex deployment, which will happen over a period of next 2.5 to 3 years, the total capex is around 2.7 to $3 billion, out of which we believe that as per the government guidelines, as per the ISM policy of the government, almost 70% will be funded both by the central and the state governments. So our outlay should be closer to $800-900 million, which will be done over a period of 3 years. And we also have a technology partner in place. Of course, those numbers will be worked out on clearly what is investments the partner would make, or so that is something that will be worked out over the next few months. But I feel that the company has strong internal accruals, strong earnings visibility. We still have a very low debt to equity in the company, so we can always manage to take some more debt. And also, we also have an ESOP program running. So we also are expected to get a lot of ESOP proceeds over the next 2-3 years from our stakeholders, which is the employees. So I feel confident that large part of this or a significant part of this capex can be funded over a period of 2-3 years through all this mechanism.